Hello and welcome to Close of Business. I'm Alicia Barry. Investors scrambled for cover on Friday after Israel launched strikes on dozens of military and nuclear targets in Iran. The strikes came a matter of hours after US President Donald Trump flagged a strike by Israel unless Iran agreed to halt production of material for a nuclear bomb. Israeli Prime Minister Benjamin Netanyahu has said the operation will continue for as many days as it takes to remove the threat. Crude oil prices spiked by more than 10% as the escalation of the Middle East tension threatens supply. Benchmark Brent crude prices climbed above $76 a barrel to the highest level since February this year. Gold prices jumped more than 1% and risk assets were sold off. The Australian share market took a hit, but the falls were cushioned by surges in energy and gold stocks. Helped by the losses at the time of recording on Friday, the market made barely any ground for the week. The ASX 200 and the All Ords just in positive territory. Independent market economist Evan Lucas has been watching the events unfold. Evan, Israel's strike on Iran has injected quite a bit of risk into an oil market that had been down due to concerns about the global outlook and supply increase from OPEC+.
Yeah, it had. And not only that, we'd also seen OPEC sort of playing its games in this market where it tries to basically stamp out its competitors by driving price down. And that's the big impact of this escalation in the Middle East. A 10% move to the upside at one point is on the Friday trading is staggering, particularly the fact that it was during Asian trading, not during European or US trading. Shows you just how, not just volatility you're talking about there, but the future risk around energy security, supply of petroleum. I mean, Iran goes between being either the third or the fifth largest producer in the OPEC group. They also tend to react as a unit as well to how this works. What does that mean also for defence contracts, defence supply in energy, etc., is all why that spike in energy prices and that risk that you alluded to is not just a story for Friday, it's now a story for the future as well.
Yeah, and so how far could this go? I mean, it is early days. JP Morgan thinks a worst case scenario such as the closure of the Strait of Hormuz or a major retaliation from Iran could send oil beyond $100 a barrel. We're at about 76 now.
Yeah, and that like very, very quickly too. And that's the retaliation. So what is the retaliation? Will it be military, but also will it be trade embargoes and trade blocks? I mean, the Strait of Hormuz, the reason that's a massive concern for Europe is obviously it goes straight on through to the Suez Canal and then into the Mediterranean. Going around the Cape of Good Hope is an extra 2 to 3 weeks of trade in general. So this is not just an energy story. It can start filtering over into other things as well. We saw that, when we saw the Evergrande scenario a couple of years back where that blocked up the strait. That is why this is more than just an energy story going forward and why, yes, you could see oil going to $100 a barrel, but it will also drive spikes in trade concerns because the transport of goods also gets locked up. Does it also bring about, more instability in the region already from the other side? We have seen issues around pirating and pirate issues in that part of the world. This all just makes that whole strait even more risky than it was.
Not surprisingly, spot gold prices are also up just over 1%, but the spot gold price is 30% up this year, with investors increasingly seeking safety.
Yeah, and okay, so let's put the geopolitical issues of what we just discussed to one side. This is another geopolitical risk issue, isn't it, around what's been going on in the Trump administration, what's been going on in tariffs, and therefore the impact on inflation, the impact on rates, the impact on investment, and therefore overall returns. I mean, it has been a flight towards gold, not just this year, but for probably the last 18 months on, global slowdown growth, the instability that tariffs have brought. All of that means that the flow to risk-off assets has been a one-way trade for a while and has just rapidly continued to ramp up. There's every sign that it will continue to go. I mean, nobody thought we'd be talking about 2,000 US an ounce and then talking about 3,000 US an ounce. And now there are some people forecasting even 5K by the end of the year with all of the risk that's going on, because gold is the only asset that some people will point out that doesn't have risk. I mean, it was US bonds, but they are under a huge amount of pressure. And that, American exceptionalism sort of investment risk is now there. And that's also what's helped gold move to where it is. It's a fascinating movement in a product that still is an inert metal. It's got very limited overall movement in terms of what it does for actual output activity. And that's why at the same time, you've always got to take what's going on in gold with a pinch of salt, but it's a fascinating mover at the moment.
Absolutely. And as you say, risk assets are certainly out of favour. We saw equities sold down on Friday. The Australian share market did fall, but it was really insulated by those big moves in oil and gold stocks.
Yeah, and that's what happens with us. It's sort of weird in the fact that we've always argued that the ASX is not diversified enough, but realistically it's barbell, being financials one end and cyclicals and energy stocks on the other, sort of weigh up each other in terms of that space. I mean, we forget this week the ASX hit a record all-time high on Wednesday, and that is also where we currently are asking that question. Everything we've just discussed is about the risks, the geopolitical issues. Markets on the equity sides have looked through that, fascinatingly so. Again, I think we are now getting to that inflection point, that it will start to come home. We know the president in the next 2 weeks is also likely to bring in the finalisation of what the tariffs will be for the globe. That's coming. We've now got geopolitical risk in the Middle East ramping up even further. Gold is telling us that there's risk. Bond markets are telling us there's risk. Equity markets, yeah, they moved down on Friday, but I think there's also more than that. They are overvalued to where they currently sit, and the risk in them is incredibly high at current pricing.
Evan Lucas, always great to get your insights. Thank you.
Thanks, Alicia.
Donald Trump says the US trade deal with China is done, subject to his final approval and that of the Chinese president. But far from done, 2 days of tense negotiations in London yielded little new, with China agreeing to ease its stranglehold on rare earths, the US in turn allowing Chinese students back into the US. Tariffs remain unchanged. East Asia correspondent Kathleen Calderwood reports.
The US President Donald Trump has taken to his social media platform Truth Social, posting all in capital letters that the deal with China is done, subject to his and the Chinese president's final approval. Now, in that post, he says that China will supply upfront magnets and rare earth minerals to the United States. In turn, he says America will allow Chinese students to attend its universities.
We made a great deal with China. We're very happy with it. We have everything we need, and we're going to do very well with it, and hopefully they are too.
Mr. Trump also said that the remaining tariffs on Chinese goods would be at 55%, which the White House has since clarified includes some previously existing tariffs, while the Chinese tariffs on American goods would stay at 10%. Now, Mr. Trump also said in a separate post that he would work with the Chinese President Xi Jinping to open up China to American trade, casting that as something that would be a great win for both sides. Now, this, of course, comes after 2 days of intense trade negotiations between Chinese and US trade teams in London. Now, at the end of those meetings, we heard from both sides that a framework had been agreed to deliver the agreement that was reached in Switzerland last month. Now, of course, that agreement in Switzerland saw both countries lift most of the very high tariffs that they had put on each other for 90 days while these trade negotiations continued. But we had seen in the following weeks both sides accuse the other of breaching that agreement. So we heard from the Chinese trade representative Li Changgang yesterday. He said that the talks had been candid and rational. He said the framework deal had been agreed upon to deliver not just that agreement reached in Switzerland, but also the consensus that was reached last week when Mr. Trump and the Chinese President Xi Jinping spoke on the phone. Now, many financial analysts and commentators so far have really been casting this deal as more of a truce, a détente, rather than any great win for business, because of course moving forward investors, businesses are still going to have to navigate that 55% tariff on Chinese goods coming into the US, but also the uncertainty of all this trade business going forward, and that of course is on the assumption that this trade deal holds.
Kathleen Calderwood there reporting from Taipei. At the heart of the negotiations is Beijing's export controls on rare earth magnets, controls which have been causing international supply chain disruptions. Clinching a deal on rare earths is critical for the US, with magnets used in cars, electronics and fighter jets. Amelia Terzon reports.
From this little shop, Mike Newbin is selling a critical component. So is that a rare earth magnet?
Yes, absolutely. So it's made from neodymium. It's only like a 40, 50-year-old invention, but these things are just super strong. They're probably 10 times stronger than other magnets.
All of Mike's magnets are made in China from its vast critical minerals reserves. The superpower has been restricting access to them as its trade war with the United States drags on.
The factories who we deal with in China, they literally cannot get exports of rare earth magnets through their customs.
And so what are these used for?
It's because they're used everywhere. You don't know that you own them in your own house, but they're already in there, in every appliance, your car, your fridge, your radio.
Beijing's export restrictions are also threatening the production of cars, wind turbines, even fighter jets.
For the last 30 years, China has had an effective monopoly in the processing of rare earth elements into metals and magnets.
China's stranglehold is clearly worrying Donald Trump, with the US president ordering an investigation into supply chain vulnerabilities, citing security and economic concerns. This month, he told reporters that he'd struck a deal.
President Xi agreed to restart the flow of rare earth minerals and magnets?
Yes, he did.
Now, after trade talks in London, more confirmation.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation.
Both sides now have to go back to their respective leaders to get sign-off.
It's going to be quite an extended period of negotiations going back and forth on key issues for both countries, and that reduces those sort of downside risks to global growth, which is obviously important for Australia.
The World Bank expects global growth to slow to 2.3% this year.
This will be the slowest pace since 2008 outside of global recession.
Trade wars and tariffs are going to be front and centre at the G7 summit in Canada. Australia's leaders are being urged to use that opportunity to promote Australia's burgeoning critical minerals industry as an alternative to China.
The opportunity is here. We have the know-how, we have the people. What we lack is the political will at the federal level. We can work with America because America is desperate to solve this geopolitical problem.
The federal government says that it's pouring $4 billion into critical minerals as well as tax incentives. Back at his shop, Mike is hoping that global trade resumes soon.
We've been contacted by overseas companies.
Like cold emails?
Yes, and they're desperate. They need, 500,000 magnets to produce 500,000 widgets or whatever it is.
And anything you'd like to say to President Donald Trump or the President of China?
Well, just to sort it out as soon as possible, because it can only get worse the longer it goes.
He's hoping the latest talks stick.
John Lee is a senior fellow at the Washington-based Hudson Institute. He says the US and China are in the midst of a breakup, separated but not yet divorced. John Lee, welcome to Close of Business.
Thanks for having me.
I've read that Trump's trade war is turning into a fiasco. Would you agree with that description?
It's unpredictable and there have been moves backwards and forwards. I wouldn't describe it as a fiasco, at least not yet. I think Trump is trying to find the right level of tariffs to achieve his purposes. But it's not looking predictable, and that creates its own problems, but I wouldn't say it's yet a fiasco.
What do you think the goal of Trump's trade war is?
If I had to rank them, the number one goal is American reindustrialization. That is something which not just Trump, but people across his whole administration support. So the idea is that if you want to sell to American consumers, as much as possible you have to produce in America, and the reason why they want that is to create manufacturing jobs in America. But then there are other goals, not all of which are consistent with each other. Some will think it ought to be directed against China, for example. So some will say that there should be extra high tariffs and other measures against China as part of a geopolitical competition. That is something which, yes, many people in the administration support, but it's not really calibrated with the reindustrialisation agenda as well as it should be right now.
The latest US-China trade talks in London have been described by economist Justin Wolfers as an agreement to agree. The old agreement is still the agreement. Do you think that's a fair assessment?
I think so. My description would be that the US and China aren't yet going through an economic divorce, but they're definitely going through some kind of economic separation. And they're at that stage where they're still trying to work out the terms of that separation. And they're sort of shadow boxing or shadow punching each other to work out where they have leverage and where they don't. And just like the Chinese, the Americans have discovered that they don't have all the cards. So it's almost trying to work out what can work for you, but puts you at a relatively better position than the other side. So it's going to be messy.
In your opinion, is it plausible Beijing is deliberately drawing out negotiations with the US using its hold over critical minerals, for example?
It's trying to buy itself time, certainly more from the point of view of accessing American components and technologies. For example, components in the aerospace, aeronautical industries, advanced chips. Beijing wants those things. It probably knows that export controls are going to come, but it will want to have access to these American technologies as long as possible.
Who do you see as the victor in this trade war?
In the short term, I think China can create more disruption for the United States simply because China is the source of manufacturing inputs and manufactured products, and there's no alternative to China. But in the longer term, structurally, I think the United States is in a stronger position because if you think about the Chinese economy, it's geared towards excess production. And when you are geared towards excess production, you need someone or some economy to consume that production. And the United States remains by far the most important and largest consumption economy in the world. So from that structural point of view, in the long term, China needs America more than America needs China. But it's how America gets there and how rocky it will be for the United States with the supply chain disruptions that will occur as the trade war goes on.
John Lee, thank you.
Thanks for having me.
The country's most popular property listing site, REA, boasts 130 million visits a month, 4 times more than its competitor, Domain. But now REA is being accused of using its market dominance to price gouge, with the consumer watchdog launching a probe into alleged anti-competitive behaviour. Nazim Kadem reports.
$8.90 the bid.
It costs more to advertise a home for sale in Australia than almost anywhere else in the world. And one major player, the owner of realestate.com.au, reaps most of the advertising fees.
Put your hands together, we are sold!
We were quite surprised. We had no choice, really, to pay the price, no negotiating, and it's all, dominated by one company.
It's that soaring property listing cost that is Australia's consumer watchdog investigating REA Group.
The price rises seem to be extraordinary at a time when housing affordability is a key problem for millions of Australians.
According to REA Group's own figures, the site attracts more than 133 million average visits a month. That's 3.9 times more than rival Domain.
They're very close to having a monopoly. They've got complete market saturation. As REA became more and more dominant in the market, they've been able to ratchet their fees up. So in some cases, you can be paying $3,000 or $4,000 or more for your classified ad with REA.
Listing fees go up every year and are based on the suburb a property is sold in.
Essentially what you're seeing is a postcode tax. So realestate.com.au are effectively saying if you're from a more affluent area, you have to pay more to list your property on their portal to get the right amount of visibility. We don't think that's very fair and transparent behaviour.
In Melbourne's east, this agent says it cost about $4,500 for a seller to list their property.
If you're working with everyday mum and dad, for example, yes, when you tell them the price of realestate.com premier listing, it does sound like a big figure to them.
On top of that listing cost, REA Group charges real estate agents subscription fees that are also often passed on to customers. Aaron says homeowners also can't independently advertise their home for sale on realestate.com.au and must instead use an agent with a valid 12-month subscription.
The ACCC need to look at REA Group and whether they're abusing their huge market position to effectively control the terms, to block out new entrants into the property portal space, and also make sure that agents and, at the end of the day, homeowners are getting a fair go when they want to list their property for sale.
But agents like Joan Mooney don't feel they are getting a fair go. Her subscription fee, which allows her to place a certain number of properties on the portal each month, is rising by 34% from July.
It doesn't cost any more money for them to host the ad. It's cyberspace, it's a cloud.
An REA spokesman told ABC News that listing a property online is not free. He said the company's pricing reflects a small percentage of the property sale, and the average cost increase for listings this year is 7%. On subscription fees charged to agents, he said it's the first time in more than a decade that they've changed because of big investments to enhance the service. The company has been taking over businesses in Australia's lucrative real estate industry that hold a wealth of data about consumer habits.
Dangerous. Very bloody powerful. They will become the keeper of, which will limit any future choice and options that the majority of people are going to have.
Hey, how are you?
There are concerns REA Group could soon have its own real estate agents.
Once they're in that position, then obviously they gain greater control of the market. Now, REA have said that that is not on their agenda. Nonetheless, the industry remains concerned that that is their logical trajectory. Now, we do know that's possible because in the United States, there is one of the portals over there has done just that.
Professor Alan Fells says price gouging itself is not illegal, but
if they probe REA, they may possibly find something that is anti-competitive, like exploiting their market power in regard to ads in some other market or using it to restrict competition in some other market.
It could take up to a year before the ACCC hands down its findings.
Australia's rooftop solar boom has been a runaway success, but beneath the sunny picture lies the darker reality of a growing waste problem, and the industry is now warning it's about to get worse. Rihanna Whitson reports.
Australia's solar revolution is a global success story. It's also creating a looming waste crisis. A fifth of this solar installer's jobs involves removing old panels.
Sometimes it can be workmanship, maybe an older system can fail. It's also increased technology.
Jake Warner says new federal battery subsidies will only speed up the transition and the waste.
Post July 1, we'll see another uptick of those who have been looking into a complete solar and battery system from scratch.
There are currently 150 to 200 million solar panels installed in Australia for residential, commercial and large-scale use. Around 4 million of them are decommissioned every year as people upgrade their systems. That's set to double to 8 million,
even before the uptake of batteries.
We can actually recycle up to 85% of the raw materials inside solar panels. We don't really have these recycling facilities ready at scale like what I think we're going to need in the next 10 years or so.
Only about 10% of panels are recycled. The rest are stockpiled, sent overseas or end up in landfill.
In a solar module there are metals that are in short supply, copper and silver, and in fact the silver that's contained inside solar modules equates to, in its totality, Australia's biggest silver mine. So landfilling these modules is wasting critical resources.
As the world runs out of the critical minerals used in solar panels, experts say the stakes are high, not just for the environment, but the economy too.
By 2035, there'll be a 30% shortfall globally in copper. The International Energy Agency is recommending that all countries adopt a regulatory and policy framework that encourages recycling so that we can use urban mining to bridge that 30% gap.
The industry says the solution is simple and long overdue. It's calling on the federal government to get on with setting up a mandatory product stewardship scheme, which would help fund the recycling of solar panels through a levy imposed on importers and manufacturers. Several solar recyclers have gone bust, waiting for a national scheme to be set up.
7 years since we've been in operation, I think we've seen at least 2 or 3 businesses come and go.
Currently, recycling solar panels can be costly and logistically challenging, leaving businesses like this open to being undercut by scrap metal dealers and exporters.
They are able to pay customers, being the installer themselves, to remove that system from their warehouse, put it into a container and ship it overseas. Unfortunately, we're not able to compete with that.
Left in limbo, there are fears the industry could collapse.
The biggest question that we get asked is around certainty of the supply of solar panels that we receive. And without that certainty, it's really hard to give an investor confidence to invest in our business.
A call to save the very resources needed to power our energy future.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.